Hey, good morning, everybody. I hope today is Monday morning, in case you're not joining us live. If you are, I hope you had a great weekend, and I look forward to spending a little bit of time with you this morning. This morning, I picked a somewhat wonkish topic, and it's a little technical to start off on Monday. Maybe we should start off with a lighter topic, but I read a working paper by the Federal Reserve Bank of Philadelphia about mortgage overpayment. And what mortgage overpayment is the difference between the interest rate a borrower receives and the lowest possible rate available to that borrower, either in the marketplace or by that same company. And when we look at when studies have done research on whether home buyers and borrowers are getting a competitive rate, or if there's, for lending purposes, it's often those studies have been marred by not having great data. I mean, we can always go, look, you're not comparing apples to apples, you're comparing apples to oranges. You're comparing somebody with a 760 FICO score to somebody with a 620, or you're comparing somebody that's self-employed to somebody that's W-2, or you're comparing somebody that put 5% down versus somebody who put 20% down. I mean, there were so many variables that you couldn't really say, did one person overpay or was another person overcharged? However, in this working paper, by the way, it's 92 pages, it's 33 pages of text, and then it's the balance of it. The other 59 pages are data on how they came to these conclusions. It has terrific charts, overwhelming amount of data. And what I can tell you from my perspective is this is really the first time that an agency has been able to do a study that actually compares apples to apples. So it takes into account every characteristic of the borrower and then compares that borrower's characteristics to like borrowers to determine who got, how rates are spread, right? And then they did this okay, and I think they looked at something like 4 million, files. So it wasn't like a small sample set. And then they also go look at inside of a company, okay, if I'm a borrower and I have a 640 FICO and I'm putting 10% down, and if I share all the same characteristics, did those two borrowers with the exact same characteristics, did they get the same interest rate? And if not, why not? Right? And so that's what the paper is about. And it has some interesting data, and it also has some things that might make us feel a little uncomfortable. But let's see. So I'm going to share what I thought some of the key thoughts were to me. As we said, just a little bit of doing some definitions. Overpayment, is the difference between an interest rate a borrower receives and the lowest possible rate available in the market for a borrower with similar creditworthiness and loan characteristics. So that's what the word overpayment means. I looked at it from various loan channels, whether it was direct lenders, mortgage banks, brokers. It looked with different price structures and the role of LO compensation and rate. It also took into account price exceptions and the role of price exceptions, and then rate lock, differentials. So it looked at a whole bunch of data. Just to let you know, they use complete access to Optimal Blue data, including lock data, offer data, the insights analytics from Optimal Blue. It used mortgage call report data, and then it used the National Survey of Mortgage Originations, or the NSMO survey data. So it used a really big set of data. And of course, with Optimal Blue, it gets every single characteristic of the borrower. So it's really able to go apples to apples. And here's some of the things, here's some interesting things from this. And the first thing, some of these are going to go like, duh, yeah, like that's obvious, like we didn't learn anything there. So the essence of the paper is it highlights the discrepancy in the rates that borrowers get from what they lock in to the best available, and they uncover that unsophisticated borrowers end up with higher rates. I mean, that's the bottom line. If you're a less sophisticated borrower and you have the exact same characteristics of a very sophisticated borrower, you're going to get a higher rate. And as we know, that's illegal, right? And so it's a problem. And this paper goes a long way to try to go apples to apples. So there's not a lot of wiggle room going, it's not true, right? And so here's some of the things. Here's kind of the interesting. If in an improving rate environment, typically lenders have higher margins and borrowers shop less. So when you have an improving rate environment, margins increase, borrowers shop less, and in general, they get a worse rate, right? By worse rate, meaning compared to what could be available in the marketplace. When interest rates are increasing, lenders shrink margins, borrowers shop more, there's far more competition and margin compression, and comparatively, borrowers get a better rate in an increasing interest rate environment. So that makes sense. We've experienced that. We definitely saw that in 2020, 2021. We totally understand what that means, right? Now, here's the next thing. Sophisticated borrowers shop more for a better rate and negotiate a better rate with their lender. So whether they shop or not, a sophisticated borrower is going to have market information and it's going to negotiate better with any lender they speak to. And then on top of that, they're more likely to shop. And so sophisticated borrowers will get a much better rate, typically, than an unsophisticated borrower with the same characteristics. And that's, and by the way, Frank Dahl was partially created to do exactly opposite of that, right? Fair lending laws are exactly opposite of that. It's not supposed to be if you're sophisticated, you get a better rate. So here's another thing is lenders with market power, and market power is market share, right? Lenders with market power charge higher rates. And not only do they charge higher rates, they charge even higher rates to less sophisticated borrowers. So with market power, what lenders have figured out how to do is the law of elasticity, where they charge people as much as they're willing to pay, right? So sophisticated borrowers are willing to pay less, non-sophisticated borrowers are willing to pay more, and so there's a discrepancy there. So that's with markups with market power. And then here's something really, really, really interesting, and we're going to talk about this in a few minutes. Lenders that charge more don't necessarily make more profit. The lenders that charge more just are less efficient and have more expensive costs. But it's not like I charge more, I make more. Really interesting is what the study found out. So here's a couple things on which lenders are the most expensive. Larger lenders with significant market share tend to charge higher rates. So larger lenders with higher market shares charge more. All right, interesting. And then, there are branch models that have a high expense model due to operational costs. It also might be due to costs of client acquisition, buying leads and whatnot, that they actually charge more, right? So and that's called a branch expensiveness. So there you go. The lenders that are more expensive are large lenders with large market share and branch models that have high expense model. As I cover this, and I know it's kind of wonkish, and I'm covering a lot of stuff, I actually wrote an article, LinkedIn article yesterday. I posted it yesterday. If you go to my LinkedIn page, look at my most recent article. I cover this. I have a bunch of this really, key takeaway, bullet points, so glossary, really easy to understand. If you're at all interested, check it out on LinkedIn. Okay, so I mentioned that, the question is, do more expensive lenders earn higher profits? And the answer was no. Instead, you know what they have? They have higher personnel costs, which translates into higher cost lenders have loan officers that make more money. Essentially, right? Now, sometimes, higher cost lenders spend more on technology and equipment, but it's mostly in personnel costs, right? And so this is crazy. Here's the next question that this paper asks, and this is where I think the key insights come. All right, so the first insight is we're not doing a good job serving less sophisticated borrowers. We're charging them more when we shouldn't. Problem one, right? We got to get a discipline not to do that. But here's what's really interesting. The paper then said, are expensive lenders better? So do lenders charge more? Are they better? And by extension, are more expensive or higher paid loan officers better, right? You know what the resounding answer was? No. No. As a matter of fact, the more expensive lenders had more complaints about delays and problems and lower customer satisfaction than lower paid lenders or the lower cost lenders. And the satisfaction had nothing to do with how much the borrower was paying. It had to do with the experience they had through the transaction. And so they found a correlation with the more you charged, the worse product you delivered, the worse experience you delivered. Really interesting, right? And later on, which I'll touch on, the paper goes on then go, how about higher paid loan officer, better quality loan officers? And so they looked at data and there was no correlation that a borrower had a better experience, better advice with a loan officer that charged more. Really interesting. I those are super interesting, right? So in my LinkedIn, article covering this working paper, I made some recommendations that are no brainers for lenders, right? Like, we have to educate borrowers to ensure that they get the best deal for them. And that's, I know it's counterintuitive because it seems like we really want to do is figure out how to make as much money as possible. But that's not the case. We just need to treat each individual fairly and we need to give them a fair price, right? We need to give them a price that we offer everyone, right? And then, we need to, we need to foster an environment where we just put our best rate forward and offer that to every customer, right? This is our best rate, regardless of how they negotiate, regardless of whether they're sophisticated. This is our rate today for a borrower with your characteristics, right? And when we do that, what will happen is we'll reduce the amount that our borrowers shop us, right? And we'll increase trust. We need to absolutely be committed to fair lending, and we just need to be disciplined. And oftentimes, we don't even know that we're discriminating. And here's how it happens. And you go, gosh, I don't discriminate. I quote the rate off my rate sheets. I get it. Great. That's perfect, right? You do that up until somebody shops you and gets a lower rate, and then you do a PE to match that rate, right? And that is the definition of a sophisticated borrower. They're shopping and they're grinding and they're asking for a discount, right? When you give them a discount and not the non-sophisticated borrower discount, you just discriminated. Simple as that, right? And so instead, if you just come out with your best rate possible and then become with overwhelming value and trust to reduce shopping, you'll probably capture more business and certainly have more lifetime business from these borrowers. And one of the things that can help us, stay, disciplined about our pricing and our pricing models and strategies is really underpinning it with technology. So technology is the one that determines pricing, not us, because we're going to do what we have to do to win the deal, which is going to then give sophisticated borrowers better deals, right? And by the way, if you want to give borrowers better deals, fine, just give every borrower a better deal. Absolutely. The paper discussed is cross-subsidized loans, like, do we do one loan at a loss so that we can do another loan at a profit? And it's interesting. I didn't cover this in my paper, in my article, but you can go back and read the actual Fed working paper. But who we discriminate the most against is FHA borrowers. I mean, the difference between a sophisticated borrower using FHA and an unsophisticated borrower using FHA has the highest spread in rate, right? And so we discriminate that. Now, there's the paper also looks into, do we discriminate by loan type? And it goes into quite a little bit of depth, like, does a jumbo borrower get a better deal than a conventional over a FHA over a VA? And it had a lot of data on that. And then the question was, gosh, is something like FHA just harder? So we have to, we have to charge more. And so it looked at all those questions that you and I, the objections that we would give. And if you're interested, check out the article. Now, in my LinkedIn article, I have a link to the Fed working paper. You actually can go to their website and then click Get the Full Report. If you like charts and data, it has 60 pages of charts. They're colorful. They're easy to understand. You can use that, in your presentations and your lunch and learns. But so there you go. That I found that interesting. I boiled down 92 pages in 15 minutes. The gist is, let's have a high level of ethics, man. Let's charge everybody the same rate. It shouldn't be, how well you negotiate is what we charge you. It's food for thought. I hope this interests you. I apologize a little bit. Started on a Monday, a little wonkish, but it caught my attention. I hope you enjoyed it. I hope you're off to a great start to your week. I look forward to seeing. Thank you for checking out my Facebook Live. Let me know whether you watch live or if you see the recording. Keep giving me your encouragement and your feedback. I'll be back tomorrow about the same time. Have a great day. Bye, everybody.